Let's talk about construction home loans or financing that you can get from lenders to be used for construction purposes on a home. So what that means, and the reason why I kind of phrase it that way is we're going to talk about two different avenues. We're going to talk about construction, meaning like you're building from a piece of dirt on up to make a beautiful home, or there's an existing home and we want to do some construction to it to add, to remodel, to rehab, add square footage, or maybe just change the inside or add new countertops or whatever it is, like construction, rehab, renovation, remodel, whatever term you want to use, home improvement. Right. So those are the two directions or two avenues we're going to talk about here. So this is kind of the big picture, broad overview, so you know what to expect. Let me just be very clear on what it's not. So construction loans, when you buy a new house from a builder, the builder already owns it, owns the land. The builder is the one building the house, and they're doing it on their own dime, meaning like they're already building the house with or without you. That is not a construction loan. You just happen to be buying new construction. So at the end, at closing, it's a normal loan. You're just buying a home from a seller who happens to be the person that built the home, right? So that is not a construction loan. It's just a loan that you're using to buy a brand newly constructed house. So a construction loan means you are actually going to be the one building and financing. You need to carry the cost of that build project. That is a construction loan. And there's two ways to do it. Technically three, but really it's two ways. The reason why I say technically three is if you don't yet own the land, you may need to go get a land loan and buy the land, and we can do them. More often than not, we're probably going to recommend and refer you out to a local bank. We can do them, but local banks typically do those land loans better. Just they're easier and just more affordable and less expensive. But if for some reason somebody can't qualify, that's where we'll come in and say, man, we can do it, but our terms just aren't as attractive typically as banks. That's not always the case, but just shooting straight, but call us and we'll walk you through it and make sure whatever bank you're going to be working with, make sure that you're getting what we expect to be normal and good terms. So go get your property. Now that you got the dirt, and sometimes, by the way, the builder, the sign in the yard, the dirt, you're driving around the neighborhood, you see it, the builder may already own the dirt. That's okay. Again, that's just the seller of the lot. So it saves you a step because now the builder bought that lot because now you have to use that builder if you want to build on that. But this process is the same, whether you own that dirt or the builder already owns the dirt. Either way, the construction loan and the construction process is the same. So here's what you need to do the construction piece. You need to get a loan. So this is one way. It's called just a two-time close. You got the dirt identified, whether it's your dirt or the builder's dirt, doesn't matter. You go meet with architect and you meet with the builder and you get plans drawn up, the little blueprints and all that's real pretty. You then get your specs, meaning like what you're gonna put hardwoods in, these rooms, carpet in these, you're gonna do, granite countertops, you're gonna do all this stuff, the specs, right? So it says, here's what the house will look and feel like. And then you get a budget. And that's where the contractor or, the builder says, cool, you want to build these blueprints with these specs? Here's how much it costs. So plan, specs, and budget. Cool. You got all that done now. So now you need to go get the loan. Because again, the builder's going to make you carry the financing. You go get a loan. So if the builder owns the lot, you're going to buy that lot from the builder and get a loan for the construction cost together. So then when you're done, the builder doesn't own the lot, you do. And you got the construction costs and a contract with the builder that says he's going to be the builder of record. So you go get that construction loan. And if you did own the property, the lot before, if it had a loan on it, you're basically rolling that loan into the new one to where you're getting a brand new loan because you refinanced that lot if you did have a loan on it. So now you got this loan. That's the construction loan. It's called the interim construction loan. So it's the interim. You're going to have it for the next 8 months, 12 months, whatever it is. So however long it takes to build that house, that's where you hold this construction loan. And the initial money that goes out the door, so it's a line of credit. So let's say the cost is going to be 700 grand for this whole thing. 200 of it maybe went to pay the lot. The builder, sold you the lot for 200 grand. 500 is going to be the cost of construction. So it's ultimately you go get a $700,000, all-in cost. 200 for the land, 500 for the build. You got 700 grand. Now the bank's going to say, hey, we want a 10%, 20%. It's probably 20 or 25% down payment. So you get that loan, you get that interim loan that $200 first goes out the door, and there's a draw schedule that the builder submits to the bank. And then the builder just says, hey, now I need my first 100 grand. I need that to get the plans, the specs, the permits, or not plan specs, but the permit and all that stuff for the city. I need that money to pour the foundation. They do all those things, and each stage of the process, now that the sticks are in the air and it's framed and all that stuff, and the windows, bricks are on and all the windows are getting put in, each stage, the builder's going to come back and ask for more money from the bank. So that line, which started at 200 grand to pay off that lot, now goes to 300, and your interest paid each month grows as the draws grow. That's the interim construction loan. So then when the house is done, you're done. And let's say it was a 20% down payment. That's 140 grand. So that means you got a loan of 560 on a $700,000 all in. Now you're done. The house is perfect. The builder was spot on and perfect, and the budget was 560. He hit 560. And now you call the mortgage mark team and you get your permanent financing, the 30-year fixed rate or whatever loan you want. You can get that done. So we then do a quote normal refinance, a normal mortgage, because the construction loan, the interim construction loan was already done with the bank or wherever it gets done at. That's the 2-time close for the construction loan. A 1-time close is where you do both of those loans together. With one institution, it's one loan, and they say, here's a construction piece. And by the way, when you're done, it just converts over to a permanent loan. There's some paperwork and stuff you got to do along the way. And so the idea there is you kind of lock in, or at least have the ability to maybe lock in your rate. So the 1-time close, when I built my house, it was during COVID. It was a 1-time close was a no-brainer. You don't necessarily save on fees. People say like, oh, you might save on fees. You really don't. It's about the same. There might be a few bucks here and there, but the reality is big picture, it's about the same. But the benefit of doing the 1-time close is I got to lock in my COVID rate, right? When the rates were really, really low. So that was the benefit of the 1-time close. Fast forward post-COVID, 2024, 2025, and rates are at 7 and 8%. You wouldn't do a 1-time close. You don't want to lock in 7 or 8% if you think rates are going to go back down. So you do a 2-time close where you go get that construction loan, and then you wait. And as rates start coming down, when you are ready to do the permanent financing a year later, you're good and you can do that. So that's the 2-time close versus the 1-time close. The 1-time, it's great because you do get it all done up front and it feels good and you're just kind of done. But the reality is it's expensive. And so doing construction loans, I don't know that I've ever done one for 300 grand because there's just a lot of costs to do construction loans. There's a construction department, there's a whole lot of fees and all these other things where economically it just doesn't make a whole lot of sense. So typically these are bigger loan amounts is kind of what we see. That's the construction side, right? So if you're building from the ground up, you're going to do a 1-time close or you do the 2-time. And the 1-time is the same as the 2-time, except it's all just done up front. So it's more expensive feeling because at closing, you got to pay it all at once, but it's the same process. So now let's talk about the rehab renovation stuff. We're not going to go into it too much because construction loans kind of imply building from the ground up. But if you are here for the remodel stuff and you're still watching, we will put more details. There's another whole section we have about videos we have about remodeling. But remodeling can be, hey, I just need to put in like some new carpet or new whatever, and it's not a big cost. Reduce the fence outside, whatever. They can be little things, or they can be, hey, I want to add on a whole second story. Those are remodel, rehab, renovation loans, whatever you want to call them. And each program, like kind of each bucket, if you will, has their own piece. So for example, on the government side of things, you got FHA, they got what's called their 203K. VA, you got VA renovation loans. USDA, they got something that's like a loan and bond and grant program. I don't like to do those because I've never done one and I'm not going to. I'm going to refer you out if you want to do the USDA one because it's so few and far between. We're just not good at them, and I'm not going to make you my guinea pig. But those are the government ones. We're great at the FHA and VA ones. The USDA is just not something we're going to touch. It's not in our wheelhouse. On the conventional side of things, jumbo, we got jumbo renovation loans. Fannie Mae's got their home style. We can do that one. Freddie Mac, their choice. We do that one, and we do them all very well, by the way. And then if you really want like something really small, we might look at the HELOCs, and we might not do that. I may refer you to a local bank that the HELOCs really, really well. So it just depends on what you need and want. We'll determine which one of those we go with. So check out the renovation side or remodel side of what we have here on the website. It'll kind of help you decide which one might be the right option. And obviously that's our job. Just call us. Save yourself, watch all the videos and just call us. But hopefully that at least explains what construction loans do exist. Again, they are more expensive. Thousands of dollars more expensive. I'd say $3 grand, 5 grand more than normal loans because again, you got stuff, and there's going to be a point on that construction loan. So the interim loan or the one-time close, you're probably going to have half a point to a full point on that from a cost standpoint. So it's expensive, but it's your home. It's worth it. It's awesome. So call the mortgage market team. We'll be happy to walk you through the process, answer other questions. While we can do most of what I just said, maybe an instance or two where we send you out to somebody we like or you can pick, and we'll just help vet those people with you. But reach out to us. And as always, when you think mortgage, think Mark.